Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The Talking Point today is to try and assess what the impact on a certain sector of the NBFCs could be, namely the housing finance companies. Now, most people that I speak to and most brokerage notes that I read seem to suggest that the housing finance space is probably the best or the relatively the better placed one in the list of NBFCs that get impacted due to the moratorium and the risk of the rising NPAs that lurks ahead. We do not know for sure, but it seems a probability. The question, though, is, or the counter to that, is also the soft real estate demand, and could that hit the basic inherent demand curve that the housing finance companies have seen all through the last few years? So, to throw more light on this about the sector, and then, of course, their individual companies as well, we start off the conversation with Kapish Jain of PNB Housing Finance. He joins us right now on the show to talk about his company and his thoughts on the space. And post this conversation, we'll also have CanFin Homes try and dwell some light on that as well. Kapish, so good having you. Thanks much for taking the time out and speaking to us. Hope all is safe.
Absolutely fine. Thank you.
Touchwood. What are the challenges of the lockdown and the realities of the post-COVID world, Kapish? I mean, everybody's been debating endlessly about what the moratoriums mean for different entities. I'm guessing the real truth would be, or the proof of the pudding would be, post the moratoriums end and the ugly face of the NPAs, if they were to come to the fore, would come about.
Yeah, the challenges of lockdown is uncertainty. We doesn't know how things are going to span out, how things will unshape. And therefore, it's difficult to plan yourself, and you need to have multiple options ready for yourself to be better prepared. So one challenge of lockdown is that it's difficult to connect with your stakeholders. It's difficult to operationally work in the right way. And this is still a touch and feel business. You just can't do everything online because the registration has to happen at the place. The legal technical has to happen at the venue of the customer who's buying a property. So some of these issues really make a challenge for you to operate fully operational seamlessly. And we are trying to just see how we can best manage it. And on your point of moratorium, it's about education. If you just see the trend, our own trend is suggesting that the moratorium availed under moratorium 2, which came in subsequent to the moratorium 1, is far lower. So people are realizing that they are not benefiting by availing moratorium. They would only be postponing their commitments, and their tenure of loan will only get extended multitude. And therefore, it's all about giving them the education and the learning. You need to segment it between whether it's for a housing finance or a CV finance or a microfinance, because housing finance, as you rightly mentioned, is the most secure asset, because it's always proven that the housing finance is first on the priority to make payment for, because people have a high property value compared to the loan that they hold, and therefore they don't want to just default on that particular payment. And in the last 6 months, people have also cut down on their expenses. Expenses any which ways have come down, so therefore the savings have been built up as well. So I don't really see it's going to be a major concern coming in, particularly for the housing sector on the salaried class to start paying their liability once the moratorium is over.
What's your sense of what kind of asset quality issues could come up for you and for the space at large? Because while, yes, it is true that housing is probably the most secured, would it escape unscathed completely, or could there be issues? And could there be issues of a larger nature?
No. So as I said, you're right. So housing would escape the entire concern coming from the sector, because the housing sector, more particularly the home loan sector, and even then the salaried sector, even the current trend that is suggesting for us is showing that the collection is becoming more healthier every single month. And but then if you segment the sector between a housing product and a non-housing product, which could be a lab product or a corporate developer product, there again, these three would show different colors. Even the moratorium is showing different colors. So you need to see how you manage each of them separately and have different strategy to manage them. But on the flip side, if you notice, the real estate has been on a 7-year slump. The CAGR for 7 years is around 2%. And therefore, the affordability index, I would presume, is at a decade high or even higher, which means that there's enough room available in the property value now after all the meltdown that has happened, where it still gives you enough safe measures in the form of the loan to value, where a person would be there to pay his liability because the asset value is still higher than what he's owning as a liability, given the all meltdown that happened in the property value itself. So that way, I would presume that the sector is far more safer compared to many of the other sectors.
In your conversation over the last 2-3 months with the brokerages, fund managers, etc., do you sense a tilt in the minds of investors in terms of, at least in the housing finance space, towards those companies which have got a higher proportion of salaried class people as their customers? Is there a tilt that you sense?
Yeah, so that's true actually, because if you are in a salaried sector, it won't be a widespread impact. In a self-employed sector, it's your business, your operations, and therefore your cash flow which gets impacted in your ability to service those loans. But if you're in a salaried sector, you still be getting some salary. There could be some cuts happening across, but you'll still be able to manage your key liabilities. And as I mentioned, among the list of liabilities, the most priority liability that somebody would like to service is the home loan, and that's where you are the safest on the ladder to get your money back. And that's precisely why it's viewed that the home loan and the salary sector is the safest. But if you just talk about us, we are also in the self-employed segment. Almost 50% of ours is in the salaried segment. The second tranche is in the self-employed segment. But in the self-employed segment, the loan to value is far higher. Our loan to value is around 48%, which means it gives me enough cushion from a property cover perspective to safeguard myself in any potential credit leakages which can happen. So that's the second safeguard that you get from the self-employed. But on a broader perspective, people do prefer that the most safest haven is the salary segment from a recovery perspective.
Hmm. Kapish, a couple of points that some research houses have brought out, and I would love your thoughts here. One of the notes states that in terms of individual companies, barring PNB Housing, all other HFCs have claimed a lower moratorium. And for PNB Housing too, this number is higher owing to the developer portfolio. What would your response be to this? Because almost, I must tell you, all the conversations that I have had with market men on Talking Point, portfolio managers or otherwise, they are all worried about this one particular piece for the space at large, which is companies which have a higher proportion of the developer loan portfolio, because that may be at higher risk than, as you said, salaried people giving in the money. How would you respond to this?
Yeah, so now I don't know from where the data came in, but the data may not got updated, might not have got updated with the second Morat data. Right? In the first Morat data, our share on the Morat availment was around 50%. But in the second Morat which came in, it dropped to around 39%. It dropped significantly. And more particularly, it dropped in the individual retail segment. In retail segment, it went to as low as 29%. It was all because a lot of awareness got created where we connected with our customers through our technology one-on-one, gave them more specific illustration to make them understand that not by paying 2 months of EMI, their loan actually extends to around 6 months and 8 months. And that's where the realization came in that it's better that they service their loan. So we think that it's now in line with what the industry would be, if not better, more so on the retail segment, which is the lion's share of our book. So yes, there could be players who have a far higher proportion of wholesale book or the corporate assets where they might find challenges, but ours is around 82% is in the retail segment, so we are relatively better compared to many of the other players. As far as the developers are concerned, there again we deal with the top developers. We deal with the type A developers who are in the top notch, and therefore they have enough liquidity and they have enough support available from their own corporate standing perspective to be able to service their loan. So there again, while there are developers and most developers have availed for moratorium, in terms of ability to service should be still better, given the segment where we operate in the developer segment.
Has historically it been that way again? Because I mean, if I just look at the gross NPAs, and please correct me if I'm wrong here, Kapish, but it may not be higher double digits, but it's certainly not lower single digits as well. Your NPAs that have stemmed from the developer loan portfolio, right? Am I wrong? And
Yeah.
again, if that is the case, uh, how is one to predict what could happen ahead, considering the times are just so uncertain? What makes you confident that this asset quality from this particular portfolio will not spike? The asset quality concerns will not spike.
So, Neeraj, if you would have been tracking us over the last couple of years or 18 months at least, we have completely stalled any new fresh line of disbursement in the corporate sector. It's the developer sector. So that's one way to stop any kind of asset quality fall. The second thing that we are doing is we are selling our portfolio on the corporate asset. In the whole of FY20, we sold around 2,300 crore. So the mere number of wholesale segment or the developer segment book has come down from around 18,000 to 14,000 today. We won't be disbursing anymore in this segment, at least for the foreseeable future. And we also intend to sell. We are in an advanced stage conversation of selling some portion of this asset in the next next few weeks. That will also stop any kind of further deterioration. NPA per se is a percentage between a numerator and a denominator, right? So the lower the denominator and if the numerator stays where it is, this percentage might look as a higher number. But we are very confident that given that we are not adding any new asset in that portfolio, and we only have a limited number of assets which are currently under concern, which needs to be addressed. And we have a crack team, which we call the remediation team, which is working on these to resolve them 24/7. So we believe that we should be able to resolve them in the next, maybe in this fiscal or sooner. The assets that we have considered, there are not too many of them. There are around 4 or 5 of them, which you need to resolve collectively.
So you don't think it could be a problem? Okay, fair call.
And particularly, Neeraj, it's, as I mentioned, it's difficult to foresee how COVID will unturn, right? But 2, 3 indicators which suggest is that the real estate sector is at an all-time 7-year low. So there's enough affordability which has come up. There's enough measure that the government has also announced, the benefit which is available to the developers in the affordable segment to get absolute tax-free kind of a benefit are all add-on which is going to make some differences in the entire span.
So you don't reckon your asset quality numbers could show a sharp deterioration going ahead?
No, it's difficult to predict that, so I can't commit on that, and I'm sure. But the one important thing which you need to always make sure is to make sure that you have adequate coverage available for your bad quality assets, which is called the provisions, right? Our provisions, if you compare for anybody and the best of the players in the market, our provision in the real estate corporate asset side is 100%, so which means we have provided for all the bad apples that we have in our portfolio. On the retail side, our provision is 87%. With the kind of asset quality that we have maintained in the retail, it's more than adequate and very, very conservative that we have provided. Even then, the balance sheet is at around capital adequacy of 18%. The requirement is 14% from a regulator perspective. Our gearing is comfortable. So we have made sure that we are strengthening the balance sheet to take care of any concern which can come in the future. And that way, we are confident, given that our focus is to see how we resolve these cases. Beyond that, it's difficult to predict, but we are sure that whatever comes our way, we'll be able to resolve them in the right way.
Okay, we'll also get in Mr. Kousgi in this conversation. Girish Kousgi, MD of CanFin Homes, in just a moment from now. In fact, joining us as well. But final question to you, Kapish, and let's get in Mr. Kousgi in this conversation as well, because I wanted to hear this as well, and then kind of carry on that line of conversation with him. But Kapish, final question to you. How is the quarter gone by been for you? I know you can't give exact numbers. I wouldn't want that as well. But can you give us a brief outline?
Yeah, so we actually gave a press release, so I can share to the extent that we gave and mentioned in the press release. We disbursed for the quarter around 800 crore, and the numbers have jumped up between the first month of the quarter to the last month of the quarter, which means that the signs of economy moving up and opening up. And the quarter per se has been fine because of moratorium. The runoffs have been lower, the assets have held itself fine, and we have worked hard on 2 particular elements. One is on our liquidity, and second is on our collection, which is the recovery. So our liquidity is fairly comfortable. We are sitting on liquidity which is around 10,000 plus as of today, and which is very, very important. The 2 very prominent things that you need to make sure in this particular times is your liquidity and your capital. And these are 2 things that we are working, and the quarter per se has been fairly good. And we are looking forward to the lockdown moving out and economy going back to a shape sooner.
Okay, Kapish, we'll leave this conversation at that with you. Thank you so much for taking the time out and speaking to us today on Talking
Pleasure.
Point.
Thank you very much. Thank you.
All right. And in fact, continuing that theme, let's get in Mr. Girish Kousgi as well. He's joining us right now. And if you look at his quarter 4 numbers, they seem to be spick and span. The question is, can it continue ahead? Mr. Kousgi, so good having you. Thanks so much for joining in. It's been a while that we last spoke on BloombergQuint, so good having you.
Good morning, Niraj.
Hi. Yeah. Mr. Kousgi, I'll start off with the same question that I asked Girish first, and then move on to the other things. If you can give us a brief flavor of how the last 3 months have been, because I'm sure it's been very choppy for most industries, and yours would not be too different, I guess.
Okay, so I'll talk about past and not talk about future because we're in silent period. So anything specific to the company I can't share. Last 1 year, we've been very clearly focusing on liquidity. That's a top priority because after ILFS and Diwan, we knew that the market is very hard. Business is hard to come by, and therefore we very clearly focused on liquidity so that we can price it differently and still keep our margins well. So in terms of last 3 months performance, last 3 quarter performance, it's been amazing. Even Q4 was very, very good. So we were able to maintain our asset quality, maintain spread, NIM, and even on the disbursement front, we lost about 8 days in March. Otherwise, we would have shown a growth of 17 to 18% YOY. For Q4. So it's been pretty comfortable for CanFin as such last 3-4 quarters. And very clearly, our focus is on liquidity, asset quality, and growth. Growth came back in Q3 and Q4 as well. So past has been really good in this trying times. So I think that's about last 3 quarters.
Yeah, I'm just wondering again, since the time the moratoriums have come in as well, and as I was talking to Kapish about it as well, that everybody seems to suggest that housing finance would escape relatively unscathed. I'm just trying to get an industry view from you. What could be the challenges to that assumption? Yes, we all know home is secure. That's the last place that people would default, etc. Surely there have to be some challenges to that assumption as well, right?
See, COVID is a reality. That's the new norm. We all should be aware of that. There's definitely pain in the industry because of COVID. The pain is less compared to other assets only because home is secure. The pain probably in unsecured like cards and PL is much more. BIL is much more than home. But even in home, there's a lot of pain because in this COVID time, obviously business wasn't there. There was lockdown for almost about 70 odd days across the country, and therefore there has been loss of business for for SME, and also on the salaried side there has been some job losses and pay cuts. So definitely pain is there. Pain is less when compared to unsecured. I think it's no brainer to predict this. But within the housing industry, the other challenges were one is in terms of collections because of moratorium. Obviously, collections were quite low for most of the companies for first couple of months. April was quite low for the industry, and May was slightly better compared to April. So every month would be better than the previous month. But yes, April and May was not that good for the industry. To that extent, a collection would have been less, and obviously they had to manage to have enough liquidity in place just to take care of all the obligations. And because of this, even flow of credit was a challenge. So it's not that everything is fine with the housing industry. There are many small players who have gone through a lot of stress in this period because bond market dried up. CP markets was not available for non-better rated companies. Obviously, there was pain. Thanks to Morat, to that extent, there was some leeway given. Some of the HFCs also got moratorium on their loans. So I think some of the schemes announced by government is really good, but pain is still there. This pain will be there for next 3 to 4 quarters. We can't wish away from this pain.
Can I ask you, Mr. Kousgi, over the next 12 months, what is it that worries you more? Is it um, a slump in demand and a loss of business for you or for the industry? Predominantly for you, but for the industry as well, if you will. Is it part A, which is a top line growth not being as fast because there's a demand slump and therefore disbursement slump? Or is it the risk of asset quality issues cropping up? Um, because who knows, post the moratoriums getting over, what would the consumer behavior be if indeed the economy does not pick up and jobs don't come back with a bang?
If you ask me in the order of priority, I think as an industry, one should focus on asset quality. I think that's the crux. Asset quality, how well they can manage, actually determines how well the company can do in the next few years. It's only a question of time that demand will be back. Demand will be back. Earlier it will be in affordable, then it will be non-affordable. It's only a question of maybe another 6 to 7 months time. If COVID doesn't deteriorate, we can see demand coming back from December, Jan onwards in affordable space, maybe a 3 or 4 months later in non-affordable space. So I think it's only contextual to say that demand is not going to be there. That's only because of customer connect, which is very difficult now during COVID time. So I think not much of challenge on the demand. Definitely, yes, it impacts the top line to a certain extent, but I think that is something which industry can live with. So there's no issue on demand. It's only a question of time. But yes, coming back to asset quality is something not that which happened now. It's not an event, it happened now. COVID is only a trigger. It depends on the way how you build the portfolio, how you know what kind of policies you have, what kind of collaterals you find, what kind of LTVs you lend, and at what rate. So it's combination of all these things. So companies which have a very low delinquent pool will be able to come out of this quite fast vis-a-vis compared to companies which are more skewed towards high value, more skewed towards AC, NP, which are more skewed towards developer loans, corporate loans, and stuff like that. So it's only a question of time. It's going to be affordable first, followed by non-affordable. But in the order of priority, first is asset quality, then liquidity, and then of course the growth.
So would asset quality be a worry for you too?
See, it's not question of whether it's a worry or not. Every single company in the industry, asset quality will deteriorate. Definitely it will deteriorate. The way I see is that Q2 there won't be any change because there's no movement of if morat is announced, if part 3 comes, that is still November, then obviously it gets extended by 3 more months. Otherwise, I would see NPS in home loan almost going up by about 80 to 90% at the industry level. And for LAP portfolio, it will be slightly more than double. So, assuming that there is no extension of moratorium, Q3, obviously NPS will surge. Q4, I think some of the good companies will be able to contain. Maybe in next 3 to 4 quarters, some of the good companies will be able to bring back NPS to the current levels of maybe Q3 or Q4. And certain companies, which were skewed towards high value, which were skewed towards, different type of collaterals, they may take maybe a couple of quarters more. So asset quality is definitely going to be a challenge for all the companies. It's the degree of challenge. For some, it's less. For some, it's more. But definitely, it's going to be a challenge. And it's only a question of time again. Maybe another next 4 to 5 quarters, it will be back.
Okay. And we'll talk about more numbers post your results, Mr. Kousgi. But one final question I'm tempted to ask you on the back of your Q4 numbers that had come out. Your advance is growing despite the lower disbursements. Is it largely because of repayments? And therefore, would you reckon that trend could well continue into the whole of FY21, if not the first 2 quarters of FY21?
So, if you ask me, there are 2 reasons. One is we have a very strong loan retention team, so that our book depletion is low. A. B, we did well in Q4. We lost only 8 days, but we had 24 days in March, 23 days in March. So we did very well in Jan, Feb, and March first 23 days, and therefore you could see that we have grown. Now, next, as I told, next 3 quarters is going to be a little tough for the industry in terms of growth. But it's only a question of time, only because we are not able to connect with customers now, because safety of employees and customers is more important than business. But after 3 to 4 quarters, definitely business will be back, and we can see the kind of demand what was there last year, maybe after 4 quarters from now.
Okay, Mr. Kousgi, wish you all the best. Keep up the show if you can, and of course, the times are challenging, so wish you all the best for that.
Thank you so much.
All right, viewers, thanks for tuning into this edition of Talking Point. The idea was to try and give you a flavor of what different housing finance companies are thinking, simply because everybody says that that's probably the safest bunker of sorts within the NBFC and the lending space. Thanks so much for tuning in today.